If you have a checking account, a savings account, or any kind of account at a bank or credit union in the United States, stop what you are doing and watch this. Because there are four things that millions of Americans say to their bank every year, casually, politely, sometimes even trying to be helpful. And in 2026, saying any one of them can trigger an automatic account review that freezes your money, sometimes for days, sometimes for weeks, and in some cases, long enough to miss a rent payment, a utility bill, or a medical expense you cannot put off. I am not talking about fraud. I am not talking about doing something wrong. I am talking about normal conversations, normal questions, normal words. And the reason your bank reacts the way it does has nothing to do with you personally. It has everything to do with a set of federal compliance rules that most bank tellers follow automatically, without discretion and without warning. Let me be clear from the start. You did nothing wrong. The system just does not tell you this. My name is Hank Sullivan, and I cover Social Security, taxes, Medicare, and the financial rules that affect retirees and pre-retirees every single day. Social Security and tax rules change every year, and nobody from the government calls to explain what it means for you. That is exactly what this channel is here for. Subscribe and turn on the bell so you never miss something that could cost you. Now let us walk through this together, step by step. Before I give you the four things, I want to tell you about a woman named Dorothy. Dorothy is 68 years old, lives outside of Columbus, Ohio, and spent 31 years working as a school librarian. She retired in 2022. She gets a Social Security check every month, and she has a small IRA she draws from when she needs to cover something extra. She is careful with her money, always has been. She keeps a few $1,000s in her checking account as a cushion, pays her bills on time, and has never bounced a check in her life. Last spring, Dorothy called her bank to ask about a wire transfer. Her daughter lives in Arizona and was going through a difficult divorce, and Dorothy wanted to send her $10,000 to help cover legal fees and a security deposit on a new apartment. Dorothy explained all of this to the customer service representative. She said it was for her daughter. She said her daughter was going through a hard time. She explained exactly what the money was for and gave the name of her daughter's attorney. 40 minutes later, Dorothy's account was frozen pending a fraud and structuring review. She could not pay her electric bill online. Her automatic Medicare supplement premium payment bounced. It took 11 days and 3 phone calls to resolve. And at no point did anyone explain to her why it happened. What Dorothy said, with the best possible intentions, triggered a mandatory review under federal banking compliance guidelines. And once that flag is raised, the individual bank employee has very little power to stop it. That is what this video is about. Not fraud, not criminals, regular people, regular conversations, and the 4 phrases or disclosures that put your account at risk in 2026. The first one surprises almost everyone, and it is probably the most common mistake retired Americans make. Here it is, telling your bank the specific reason for a large cash withdrawal. Now, your instinct is probably the opposite of what I am telling you. Your instinct says, be transparent. Be cooperative. If you explain yourself, they will understand. But in the current compliance environment, explaining yourself in detail can do the exact opposite of what you intend. Here is why. Banks are required under federal anti-money laundering guidelines to monitor cash withdrawals above certain thresholds. When you walk up to a teller and say, I need to withdraw $8,000 in cash, and I want you to know it is because I am helping my grandson put a down payment on a truck, you have just done 2 things without realizing it. You have confirmed the amount is intentionally under a reporting threshold, which raises a structuring flag, and you have introduced a third-party transaction that the bank's compliance system is designed to scrutinize. The teller does not think you are a criminal. The teller probably feels terrible about what happens next. But they are required to log that conversation, and depending on the bank, that log can trigger an automatic hold or a suspicious activity report review. What should you do instead? You are fully within your rights to withdraw your own money. You do not owe the bank a detailed explanation. A polite, simple statement is all you need. You would like to make a withdrawal. That is it. No reason, no context, no backstory. The moment you start explaining, especially with an amount that happens to fall near a reporting threshold, you are handing the compliance system a reason to pause. Let me do the math live so it lands. The federal reporting threshold for cash transactions is $10,000. But here is what most people do not know. Banks are also trained to flag transactions that appear designed to stay just under that number. If you withdraw $9,000 and explain it is for a reason involving another person, that explanation combined with the amount can be enough to trigger a review. Not because you did anything wrong, because a rule written decades ago to catch organized crime does not distinguish between a retiree helping his grandson and someone trying to hide money. Now, the second thing, and this one is more painful because it comes from a place of love. Do not tell your bank you are sending money to help a family member who is struggling. I know, that sentence feels wrong. You worked your whole life for this money. You have every right to give it to whoever you want. And you do. Nothing in this video is meant to suggest otherwise. But in 2026, the phrase, I want to send this to my son, he is having some financial trouble, or I need to wire this to my daughter, she needs help with her bills, is one of the most common triggers for an elder financial exploitation review. Banks, credit unions, and financial institutions are now required under guidance from federal regulators to train staff to identify potential elder financial abuse. The intent of that guidance is good. Seniors are targeted by scammers at a devastating rate, and a lot of that fraud involves a family member calling and pressuring an elderly relative to send money quickly. The rules were written to protect you. The problem is that the rule does not know the difference between a scammer pretending to be your grandson and your actual grandson who genuinely needs help. The phrase family member plus financial need plus money movement, especially if it involves some urgency, can match the pattern the system is looking for, even when the situation is completely legitimate. Dorothy's 11-day account freeze was caused almost entirely by this. Her daughter was real, the need was real, the money was hers to give, it did not matter. What can you do? If you want to help a family member financially, it is worth having a brief conversation with your banker or a financial advisor before you initiate the transaction, not at the teller window. Go in when you are not in a hurry, explain that you are planning to make a gift or a transfer, and ask about the best way to process it to avoid delays. Framing it as a planned financial decision rather than an urgent emotional response changes how the conversation gets logged. And speaking of things that get logged, the third one is the phrase most retirees have no ideas even on the radar. I am thinking about moving my money to another bank. This one shocks people when I explain it, so stay with me. In most cases, saying this does not freeze your account. But in 2026, in certain specific combinations, it can trigger an account activity review that slows or pauses your ability to move funds for several business days. Here is why. When a customer signals intent to move a large sum of money, especially a retirement account, an IRA rollover, or a CD, the bank's retention and compliance systems activate simultaneously. On the retention side, they want to keep your business. On the compliance side, sudden large outflows from accounts belonging to older customers are flagged under the same elder financial exploitation guidelines I mentioned a moment ago. The system does not know if you decided to move your money on your own or if someone talked you into it. Think about what a typical retiree sounds like in this conversation. I have been thinking about it for a while. My son looked into it and he thinks I should move it. I found a place offering a better rate. Son involved. Decision made relatively quickly. Moving a large sum. These are also the characteristics of a fraud situation. And again, the compliance system does not ask which one this is. It flags it and slows it down. If you are genuinely considering moving your money, especially a large IRA or a CD balance, give yourself time. Do not mention it casually at the teller window. Initiate the process through official rollover or transfer procedures, which create a paper trail that automatically satisfies compliance requirements rather than having a verbal conversation that gets logged with incomplete context. The fourth thing is the one that almost nobody talks about, and it is the one I want you to sit with for a moment. Do not tell your bank you are not sure why a charge appeared on your account, and then tell them someone else has access to your account. Here is the scenario. You are looking at your statement and you see a charge you do not immediately recognize. You call the bank and you say, I see this charge here. I am not sure what it is. And my daughter has access to my account. She sometimes pays things for me. Maybe she did it. That sentence in that order meets almost every single criterion for a financial exploitation flag. Unrecognized transaction, older customer, third party with access. Customer does not know where the money went. The bank cannot tell from that call whether your daughter is helping you or taking from you. And in the current environment, they are required to treat that ambiguity seriously. The result can be an immediate hold on outgoing transactions while the account is reviewed, which can last days to weeks depending on the institution and the amount involved. If you share account access with a family member, which is a completely reasonable and often very smart thing to do, there are clean legal ways to structure that, including adding them as a joint account holder or setting up a durable power of attorney, both of which create formal documentation that protects you and protects them and tells the bank's compliance system this is an authorized relationship, not a suspicious one. Again, this is general guidance, and for your specific situation, a financial advisor or elder law attorney can walk you through exactly what makes sense for your circumstances. Let me now bring Dorothy back, because her story has a second chapter. After the 11-day freeze, Dorothy did 3 things. She opened a second checking account at a local credit union as a backup, so she always has somewhere she can access funds if one account gets locked. She added her daughter as a joint account holder through the proper process, which took about 20 minutes at the branch and eliminated any future ambiguity about her daughter's access. And she started doing large transfers by calling ahead and scheduling them as intentional planned transactions, which creates documentation and almost entirely eliminates the delay. None of what happened to Dorothy was her fault. She did not break a rule. She did not behave suspiciously. She was a retired librarian trying to help her daughter. But the rules exist inside a system that is designed to catch patterns, not intentions. And once you understand the patterns the system is looking for, you can step around them without giving up anything you are entitled to do. That is the whole point of this channel. I am not here to scare you away from your bank. I am here to make sure you walk into every financial conversation in 2026 knowing what the system sees and how to protect yourself inside it. Let me give you the 4 one more time because I want them to stick. Do not explain the specific reason for a large cash withdrawal to the teller. Do not describe a money transfer as urgent help to a struggling family member at the window. Do not casually mention you are thinking about moving your money without going through the formal transfer process. And do not call about an unfamiliar charge while also mentioning that someone else has access to your account. None of these things mean you cannot do what you want to do with your own money. They mean the sequence and the context matter, and knowing that ahead of time can save you the frustration, the stress, and the financial disruption that caught Dorothy off guard last spring. Now I want to hear from you. Have you ever had a bank account flagged, delayed, or frozen and never fully understood why? Drop it in the comments. I read every single one. And you might be describing something that helps another person in this community recognize what happened to them. And if you know a retired parent, a spouse, or a sibling who handles their own banking and has never heard any of this, share this video with them today, not tomorrow. The people who most need to know this are often the last ones to find it on their own. Share it, and you might save them 11 days and a whole lot of stress.